Mo, are you there? It's Bob Knakal. Hello, everybody. How you doing today?
I am doing well, Bob, and happy Sunday morning to everybody. Or actually, morning for me, afternoon for you guys.
Yep, absolutely. Well, good. I'm glad I got the technology to work. Let me record this, hitting the record button. I hope I don't disconnect everybody. But got it. Okay. I don't know if we're recording or not, Mo. In the upper left-hand corner, there's a record option with a red button that's flashing, and it's
Y-
still flashing even after I hit it.
Yep, we're
Is the,
recording. You're good.
all right, there we go. Look at that. Unbelievable. Bob Knakal and technology working hand in hand. You gotta love it. So anyway, welcome everybody. I'm glad some folks are on and wanted to talk about 2024, what we're seeing, what's happening, what to look out for, what to anticipate, and would love to answer any questions that you guys have. So please send your questions in. Mo will be my wing woman guiding me through the questions. But just kind of as an overview, I think it's important, again, to have historical perspective, as I always say about numbers. The absolute numbers themselves don't really mean a lot. They only mean something in relation to what the numbers were before and what they're likely to be in the future. So, for some relative perspective, we're still dealing with a market where the cyclical peak was almost 10 years ago. 2014 was the peak in terms of number of buildings sold, 5,534 buildings sold in New York City. Dollar volume peaked in 2015 at 80.1 billion. We have not been close to those numbers since then, which is really remarkable given how long ago that was. It's hard to believe. Hard to believe we sold Massey Knakal at the end of 2024. It's been over 9 years, which is crazy to think about, but time just whizzes by. But we saw the cracks in the market really start in October of 2015. We saw the activity on development sites change very dramatically with bids coming in a lot lower than we anticipated. We saw cap rates on hotels go up significantly overnight. Those two sectors are lead indicators for us for two main reasons. And we always look at those two sectors as being very foreshadowing of what's going to happen. Hotels, because leases are only for one day, and the land market, because land is a proxy for what developers and other market participants believe market conditions are going to be like 3 or 4 years from today, when what they're buying is going to be constructed and they have to either rent it or sell it. So we saw tangible changes in those two markets. So from October of 2015 through February of 2020, the investment sales market in New York City was in correction mode. During that period of time, the volume of sales from a dollar volume perspective fell by 56%. The number of properties sold fell by 54%, and values were down on average, if you aggregate all property types, about 12%. COVID came along in March of 2020, converted this mostly volume correction into a value correction, and the market bottomed out towards the end of 2020. Then there was a tangible shift in the market. During the first week of April of 2021, I was contacted by 13 private equity shops within a 3-day period, all saying, hey, we've been on the sidelines. We want to get back into the market. And who's building? Who's buying? Where can we deploy capital? The reason for that was, and I thought maybe these guys had a conference and all decided to get back into the game. But what happened in actuality was that all the residential brokerage companies had their reports published for the first quarter, and they showed upward pressure on residential rents for the first time in years, a good condo absorption. This was a positive sign for the market. And sure enough, that enthusiasm and optimism resulted in a 12-month holiday from the correction, which was the second half of 2021 and the first half of 2022. If you've heard me speak or read any of the articles that I've written, I'd been kind of on the fence as to whether we are still in a correction that started in October of 2015 or we're in a second correction that happened just 12 months after the last one ended. I am definitely in the camp now that this is a second correction followed closely on the heels of the last one, because the reasons for the correction are very different. The Fed started raising interest rates in March of 2022. It didn't really tangibly start to impact the investment sales market until August or September of 22. That started to exert downward pressure on values, and we've entered another correction. So being that we just had that short 12-month holiday, generally the market has been in really tough shape since October of 15, and we're hoping to pull out of it. So what are the signs that we're going to pull out of this? Well, you need to go through what we refer to as the capitulation phase. Capitulation phase being the point at which sellers finally say, you know what, there's pent up demand to sell. I'm just going to take the market clearing price. And generally, you'll see an increase in the volume of sales as sellers start to capitulate. And I really thought that there was a good chance we were getting to that phase based upon what happened in the third quarter of 2023. We always look at Manhattan as a proxy for what is going to happen in the broader market in New York City. Whatever happens in New York will happen in Manhattan first. So if we look at the market for investment sales over 10 million in Manhattan in 2023, we see that there were 42 transactions closed in the first quarter of 23, 43 in the second quarter, and that jumped to 84 in the third quarter, more than double what we had in the first and second quarter individually. So I said, hey, we may be reaching capitulation. This is great news, but I always caveat it by saying you cannot draw any conclusions about a trend from one quarter activity. You really need to see 2 or 3 quarters to know that you have a tangible trend. And sure enough, the fourth quarter numbers stink. Only 32 sales in the fourth quarter of 2023. So we've not reached capitulation yet. And now we've had the Fed indicating that they may cut rates a few times next year. And that's had a dual impact on the market. That dual impact is that for a couple of years, the very, very uber wealthy investors that we talk to all the time, the folks who have, 9 figures of liquid cash ready to go, or 10 figures of liquid cash ready to go, have basically said to almost every deal I've offered them, yeah, Bob, that sounds like a good deal, but you know what? It's going to be cheaper in 3 months. I'm waiting. Well, since the Fed's been telegraphing that rates are going to come down, those folks are no longer saying that, and a lot of them are looking to make moves in the market and are ready to deploy capital. Unfortunately, the counter to that is that a lot of sellers who were thinking about selling, or they need to sell, or they're for strategic reasons they would like to sell, a lot of them have said, hey, rates are coming down, my value is going to go up, I'm not going to sell now. So it's had a dual effect. And now we've seen last week the inflation numbers came out. I think it was 3.4%, which is not a good number. So is that going to change the Fed's course? Is it going to maybe have them not cut rates? Very, very unclear what's happening. We need some consistency in the market and some certainty about rates to settle, and then we need to get through this capitulation phase before things can start getting back on track. And just a few comments, and then I'm happy to get to questions about where we see, how we see this correction as being different from prior ones. And what I will tell you is that each asset class, in terms of product type, is performing very, very differently, and in some cases autonomously from others. And this is very different. In past corrections, whether it was the S&L crisis, the recession in the early 2000s, the GFC, we saw that the market was heading in the same direction for all asset classes, just to varying degrees. Today, at least, and I apologize that I can only use as a frame of reference New York because that's the only market I'm active in, but we've seen different product sectors performing very differently. If you look at the retail sector, for instance, that's a sector that I think is on the upswing. But that's only because retail has been getting hit pretty hard since 2016. It's been so long that the general perception in the market is that retail rents have stopped going down, retail leasing activity is picking up, and there is investor demand again. About 3 months ago, I got a call from an investor asking if we had any retail properties for sale, and I almost fell off my chair because I hadn't gotten that call in about 5 years. And since then, there have been several other calls that we've gotten that where investors are interested in retail. It'll be very interesting this coming Wednesday. We are handling a foreclosure auction sale of 5 East 59th Street, which is the old Playboy Club building, which is an 8-story office building that likely could be knocked down to make way for a retail jewel box. And it'll be very interesting to see what happens there. But overwhelmingly, the interested buyers in that office building have been retail investors. So it'll be interesting to see how that plays out. But retail, I think, is in a very positive mode right now. The multifamily market here is very highly correlated to public policy. Our policymakers have really been destroying the market by virtue of regulation and policy that's been implemented. Essentially, every politician here says that they want New York to be more affordable for people, but yet every single piece of legislation that has been implemented or ignored since 2018 has done nothing but constricted supply and exerted upward pressure on rents, making the city less affordable. So, very hypocritical policy. But notwithstanding the political headwinds we have in the space, there is still a very, very significant demand from investors wanting to buy multifamily here, which is kind of surprising. Clearly, in that sector, cap rates are up because lending rates are up, but demand is still very strong, and that market is functioning fairly well. If we look at the land market, similarly to how different product sectors are performing very differently, it's the same within the land market. We've had almost no activity in rental land because our tax abatement program has gone away. It's expired. Legislators are talking about bringing it back in some form or another. It's unclear what would come with it if something did get enacted. But the fact is that because there is no tax abatement, even if you got the land for zero, it's not financially, economically viable to build a rental building in the city today because of the costs. So we've seen a big air bubble in that pipeline. In the condo land market, we have fairly decent activity, but values are down probably 25 to 30% in the last 16 or 17 months because construction lending has gotten so expensive. Still activity, but at a lower price point. The hotel land market is a very interesting one. Under the de Blasio administration, they put in a requirement to get a special permit to build a new hotel today. Nobody has filed to do one of those because essentially what it means is you have to do a union hotel. Most of the hotels that have been built in the city are limited service hotels. You cannot operate a limited service hotel with a union contract and have it make sense. So there's been absolutely zero of those, forget about built, even applied for. So you would think the legislators would say, hey, if we implement a program and there's been no takers in many years, maybe it's not a great program. Hopefully they come to their senses and realize that a change is necessary there. But notwithstanding that, the dynamics within the hotel market are getting extraordinarily positive and very rapidly. We have a hotel market in which there are about 120,000 rooms. 30,000 of those rooms are no longer hotel rooms. If you want to come to New York and stay here, you can't rent one of those 30,000 because 14,000 have been converted to other uses like student housing, and 16,000 are occupied by migrants. So we have a constrained supply, ADRs are up, occupancies are up, and people are really looking at the hotel market as being very, very positive today. Then on the flip side of the coin, the one sector we haven't talked about, whether it's from a land perspective or a building perspective, is the office market. I think the office market is interesting in that many of the reports that you read are very negative. I don't think it's as negative as the reports would indicate. Clearly, new construction Class A buildings are doing relatively well. Office demand is good from tenants, and it seems like if you built a new office building anywhere in the city, you could get triple-digit rents. The B and C office, though, that sector is facing challenges. The value of those buildings is, as a meaty part of the bell curve, is in the 300s per square foot. That's what it was 20 or 25 years ago. Those buildings were selling for as much as $700 or $800 a foot several years ago. And there are some buildings that are trading below 300 a foot, and there you're really not buying the office building, you're buying the land, because even if you add in the cost of demolition, you're below land value. So a lot of folks are talking about the potential to convert office buildings to residential. I think if things continue to go the way they have been going, very likely we're going to have as many, if not more, office buildings demolished to make way for new construction than we will have converted to residential. And tax abatements are necessary there. There was a 421G tax abatement program that was extraordinarily stimulative to conversion of office buildings to residential in the financial district in Manhattan. This was a program that was in effect a few years before 9/11, but in the market after 9/11, we went from having about 1,800 dwelling units in the financial district to now almost 30,000. Those were almost all catalyzed by the 421A tax abatement program. And I've mentioned to the governor that I think that program should be enacted citywide to promote the conversion of office buildings, especially older, functionally obsolete office buildings, into residential. But that's kind of where we are from a macro perspective. And, happy to answer any questions that you guys have. And Mo, it looks like we have a question.
Yes, we do. We have Andy P who wants to ask you a question, BK.
Hey, Andy, how are you?
Hey, BK, how you doing?
Good.
Appreciate you making the time. So, wanted to get your opinion on where you think the most distress is. Just trying to figure out where to focus our efforts this year in 2024. Wanted to see if you thought maybe hotels were just as distressed, or is it
No.
only office?
Yeah, I apologize. I can only really give perspective on the New York market. I would tell you, I think the hotel market is no longer in nearly the amount of distress that it was. And I can tell you that, we've sold a couple of hotels at significant discounts. We sold the DoubleTree at 51st and Lexington. That was bought in 2010 for $330 million. We sold it for $145 million.
What is that per key?
That was about 790 rooms, I think. So do the math on that.
Where do you think cap rates are headed with where the 10-year Treasury is? Are in New York City multifamily, if 20% stabilized, let's say?
Yeah, when you have only 20% stabilized, you're in better shape. And to answer your question about distress, clearly the secondary and tertiary office market is the most distressed market that exists today. And I didn't talk in my comments, I didn't talk about industrial because there's such little industrial zoning in New York that it really doesn't move the needle, unfortunately. But I think in the multifamily space, we've seen cap rates expand significantly. For the majority of my career, cap rates on multifamily in New York were 150 or 200 basis points below where they were around the country. Today, I think they're higher than they are around the country. And that's because of the legislation and the policy that we have now. I think that people are looking at the mostly free market apartment buildings as a great place to invest because of the lack of new supply that policy is dictating. But the difficulty is that I mentioned that there's probably a new 421A tax abatement on the horizon that may get implemented. All indications from Albany are that there will be a new 421A early in the next legislative session, but unfortunately, what will come with that is what they refer to as good cause eviction, which means that essentially even free market units would become rent regulated. So the big question about that, I certainly hope that that does not happen. I hope we do get a 421A. I hope we don't get good cause eviction. That would be a
Sorry, can you just give me an update there? What's the good cause eviction going to do?
A good cause eviction would say that you essentially have to give even free market tenants a renewal lease. What the tenant advocates have done is they have said that they're capping the increase at 150% of CPI, which sounds very benign. But the problem is that the folks in the know that that's probably just a Trojan horse, that it'll get passed with 150% of CPI, and in the next legislative session, they'll say, oh, that's too high an increase. Let's just make it the 1 year rent stabilized increase, and then effectively you have rent stabilization throughout the whole market. Yeah, that's the concern.
That could kill multifamily in New York City.
It would not be a good thing for multifamily in New York. And again, with that as the backdrop, what are the ramifications of that? If you think about it, so you have a co-op or a condo, you're transferred for 2 years to Europe to work, and you come back and you want to go back into your apartment and you can't get the tenant out. Or what happens to I think the value of land skyrockets because all of a sudden buildings that you used to be able to vacate, don't forget, New York doesn't have rolling pastures of land on which you can build. You want to create a development site, you may be lucky enough to buy one of the few parking lots that remain, or you're buying some crappy little buildings, knock them down, and you create land. Well, if you have tenants in the building, it's going to be tougher to get them out. So land values may shoot up. So there are a number of tangential implications that come with all these policies. And unfortunately, policymakers don't think through enough what all these ramifications can be. So that is a huge question mark for the multifamily market moving forward. What's going to happen legislatively?
With regards to motivation, Bob, I know that it's a tough market and a lot of the brokers haven't made as much as they had liked. What would you say to motivate folks if it was a Monday morning's sales meeting right now at Massey Knakal in 2009?
Yeah, well, you know what? I would say number one, make your calls, right? Because you got to keep prospecting and look for motivation. Discretionary sellers are not that likely to make a move today unless there is some very compelling strategic reason to make that move. But as a broker, you have to probe and find out why
I think I
folks
got
want to
bumped on.
sell. For 2 years now, I have been starting every presentation with, hey, you shouldn't sell now. Not a great time. Why do you want to sell? And clearly, you look for those old, reliable, have to sell things like death, divorce, taxes, partnership dispute. Today, there's refinance risk, that folks who have debt maturing that don't have the money to effectuate a cash in refi may have to sell. There are other strategic reasons people may have to sell, but you have to look for motivation. And then the other thing I always tell folks is, look, the market always has been, is, and always will be cyclical, and it will come back. It will come back. Just do things to put yourself in a position to take advantage of it when it does come back. Beef up your research, beef up your marketing capabilities, create that capabilities brochure you've been thinking about for years and just haven't had time to do it. Put yourself in a position to take advantage of the market when it comes back, because it absolutely will.
Awesome. Okay, BK, we have news flow next. After that, it's Faraz, and then we have Carol.
Okay.
News flow, you're up.
Hi, Bob. Thanks so much for taking my question.
Sure.
Yeah, I wanted to know, what are your thoughts on the public New York City office REITs like Vornado and SL Green, and also in general the demand for office going forward, as the policies seem to be a lot of the bigger banks are now forcing employees to go back to work, where a lot of those companies like Vornado and SL Green are distressed in terms of their preferred stock or their general equity, whereas some people think that office is kind of not as attractive, whereas other people think it is. I'm just curious your kind of short and long term on that.
Yeah, my opinion is, I think it's remarkable how low some of these REIT stocks are. I think they're way undervalued. I think they're a good buy today. Most of the REITs, the quality of the buildings they have are tremendous. The better buildings are going to do better. And I think that they are disproportionately negatively impacted by what's going on. And I would expect them to bounce back significantly. So I think those REIT stocks are a buy today from my perspective.
And which of SL Green and Vornado, which do you think has higher quality, longer term kind of durable real estate?
Yeah, no, that I have friends and clients at both of them. I'm not going to get into comparing one to the other, but I think look at the quality of the buildings. The better quality the buildings are, the better the portfolio is likely to perform. And with regard to work from home, I just think there's two things that really stand out to me. And I say this coming from the perspective of someone that is extraordinarily more productive working at home. I went from pre-pandemic to connecting with 50 owners a week to post-pandemic 100 a week, and I only am doing that now because I proved to myself I could do it during the pandemic when I didn't have the Seinfeldian stop and chat happening all the time when somebody comes by to say, "How was your weekend?" and 10 minutes go by. So I'm much more cognizant of stop and chats now. But I think that you have to work from the office. I think that the biggest victims of the work from home dynamic have been the younger folks who need to be in the ecosystem of the office in order to learn a lot. If you're on a Zoom call, you're focused on one issue, one deal, one thing. You don't get anything kind of through osmosis just by being in the ecosystem. And I think whether you're getting a cup of coffee in the kitchen or overhearing some colleagues talking about something, or even in the lavatory overhearing somebody talking, you get in the way of information that helps you grow. So I think working from home has flattened the learning curve for younger folks, particularly. And then when it comes to corporate culture, you can't possibly generate or foster a corporate culture by having people working remotely. It doesn't work. So I'm a big proponent of getting back to the office. As much as I never thought I would be, again, I'm a 5 day a week in the office guy. And I think some of that is just I'm a creature of habit and I've been doing it my whole life. So I continue to do it. But I think for the good of the company, folks should be back at work. And particularly for the learning and the growth of younger people, being in that environment is critically important.
Yeah, that makes a lot of sense. And do you think overall that your view is reflected in kind of the C suite where across New York, the office demand will kind of start to pick up from its low maybe in 21, 22?
Yeah, I hope that's the case. I think certainly I do not speak for the C-suite at JLL and don't speak for the C-suite at any other firm. I just know that if I'm running a business, I want particularly my sales force. I want those folks to be in the office, sitting next to each other, talking to each other, interacting with each other, learning from each other. I think that's important. I don't know whether I would have my graphics people or my research people needing to be in the office. Certainly, with the low cost of office space today, I probably would have them in the office. But if we were in the old days where rents were very, very high, I might think about having part of the workforce remote. But there are several issues that come up with making that decision. But I think most folks want to have people back in the office and working together.
Thank you so much for the answering the questions and for taking the time.
Sure thing. Great. Thanks for listening.
All right, Faraz is up next.
Hey Bob, good hearing from you again.
Hey, Faraz, how are you, my friend?
Good, you know me, I'm always working.
Yep, yep. Love it, love it.
So I got a quick question, and this is going to be New York related because you know I'm a DC guy. So this was on a podcast you were on maybe a few years ago, and somebody asked you if I won $20 million, what would be the best investment in New York? And I'm kind of in that position right now because I come from a family office background, and you talked about owning sites that could be for development. You hold it for 5, 10 years, you make X amount. Is that play still in today? Do you think right now we're at the lowest of the tranches? You could buy up like maybe a covered land play that's like maybe a B or C office building where you're getting some kind of cash flow in. You hold it for 5 years. you make X amount on the land when you sell it. Because our background is we're not developers. We strictly look on cash from cash yield, but we always look for the covered land play.
Yeah, for us, I think, I don't know what podcast you're referring to, but I will tell you my perspective has not changed on that. I think it's shocking to me the price per foot that properties are selling for today. I would not bet against New York. I do have to say that I'm slightly less convicted than I've been over the course of my career. I'm still, if I was always 100% don't bet on New York guy, I'm now maybe a 90% don't bet on New York guy, only because our political situation has changed very dramatically. For my entire career, our New York State Assembly was always a supermajority of, let me refer to as anti-real estate folks, but the Senate was always very, very close, a very narrow majority. And even when the anti-real estate folks had the majority, there was an independent caucus that voted with the pro-real estate folks. But today there is a supermajority of anti-real estate folks in the Senate also. So for the political pendulum to swing will require a very, very substantial move on the political front. And because policy is so highly correlated to the way the market functions today, that it gives me a little bit of concern. But still, I'm 90% don't bet against New York. It's going to come back. How can we have buildings selling for what they were selling for 20 to 25 years ago? It makes no sense to me. I've always said that the best buying opportunity I ever saw was during the S&L crisis in the early 90s. I think we're at the point now where now is the best buying opportunity ever. And I think 5 or 10 years from now, people are going to look back and say, what the heck was I thinking in 2023 and 2024? I should have bought everything in sight. And we saw it during the GFC. There was an office building on 6th Avenue that sold for about $300 a foot. And everybody said, oh, that buyer is crazy. What the heck are they doing buying that building for $300 a foot? They got to be out of their mind. And 3 years later, they sold it for $900 a foot. So I think it's a great buying opportunity. And I would buy any well-located retail property today. I think is a good buy. I think some of these office buildings at the prices per foot they're trading for are a good buy. I think land is poised to take off in the city. If you look at the land market, the very best land sites in New York have always greatly exceeded the prior peak by a significant amount. And I could take you back to 1986, 87. Best land in Manhattan was selling for $125 a buildable foot. In 97, 98, that grew to 350. 06, 07, 750. 15, 16, 1100. It went down into the 300s in 2020. Early 22 got up into the 500s, and today it's going back down. So I think that market is poised to see a huge, huge flurry of activity with increased pricing at the peak of the next cycle. And I think it's a great buy today.
So then my second part, and this will be the last part of the question. So usually my family office, we stick to mid-market assets. In the DC market, we would range that anywhere from 8 to 25 million. And the reason I give that example is usually anything over $8 million, it was too big for the small guy. Anything over 25 million, we noticed could easily be an institutional deal just because we got outpriced. I mean, I'll give you an example. We looked at a shopping center, we put in a bid for like 28 million at a 7 cap. REIT comes in, pays 55 million at a 3.5 cap. So if you're somebody like me trying to come in the New York market, where would you say that sweet spot is where you're not dealing with the small guys, but you're not dealing with the institutional guys either?
Yeah, look, I mean, as weird as it sounds, I always felt that in New York, the institutional market was over 100 million. Are there some institutions that buy deals for under 100? Yes. I think there's a ton of folks that play in the under $10 million market. But I think that if you look at most of the trades, and I'll tell you that in a typical year, 97 or 98% of the deals are under $100 million. So it's overwhelmingly deals are being acquired by high net worth individuals, families. There we have a lot of what I refer to as individuals here in New York that are private families or a private investor that are worth billions of dollars and as big as some institutions are. But that really drives the market. So I think it really, to answer the question accurately, I'd need to know what asset class you want to be in. Clearly, in the office sector is a different threshold than the multifamily sector, the retail sector, for what each type of investor wants to buy or where institutions would go. But I think there's tremendous opportunity.
All right, well, I'll say that question when I see you next week then.
Absolutely. Looking forward to it. Can't wait to see you.
All right, Carol, you're up next. Thanks for waiting. And then we have Kevin and Hardesh, who will be next up. And then Bob does have a hard stop at about 9:55. So let's make sure we keep these questions going.
Good morning, Bob.
Hey, Carol, how are you?
I'm great. I was going to ask you about your hot tub and your hair, but I figured you probably already
Yeah, well,
covered that this morning.
yep, I haven't covered it yet, but I do not have a suit and tie on today, I'll tell you that, but I knew I wasn't going to be on camera, so I could get away with it.
And you're not currently in your hot tub, so that's
No,
good.
not in the hot tub, not in the hot tub.
Well, I thought I would ask about what you're seeing in terms of adaptive reuse. So obviously, we've got sort of a couple of different buckets, buildings that are historically designated and others that are not. And lots of folks are clamoring to see some of those spaces become much needed housing. And as we know, for a lot of different reasons, whether it's the floor plates or the particular design, they might not be a good option. But I'm curious what you're seeing on the ground. Are you seeing people doing more adaptive reuse? And what are your thoughts in general on that?
Yeah, well, I think that it makes sense. If you go to 40,000 feet in New York City, we have probably 100 million feet of vacant office space in New York. A lot of that would be considered functionally obsolete. And there's only so much you can do to an older office building to try to make it competitive. And the two biggest things that you can't do, you can't really change ceiling heights and you can't take columns out. So that being said, conversion to alternative uses, and particularly in a market where we need housing as much as we do, and I think that's the case in most places, you need housing at all levels, all income levels, workforce housing, affordable housing. And so to figure out how to do that would be great. I've met with a couple of architectural firms that are coming up with and figuring out ways to get natural light deep into floors. A big problem with a lot of these buildings is the floors are so big that you have a lot of space that's far away from windows. So how do you deal with that issue? I know in New York, the economics are such that we really need a tax abatement program to incentivize that kind of thing. But I think that people are looking at changing use of all types of buildings, not just office. Folks are looking at warehouses, they're looking at medical facilities, changing them to other uses. There are a lot of different potential changes. People are looking at ways to create value, add value to properties, and be creative. And the amount of vacant space that exists makes a lot of these plans potentially viable because moving tenants has never been easier. To move a tenant from one building to another, they're probably going to pay less rent, and there are a ton of choices for them to look at. So the feasibility of it, I think, is high. It's just a question of, from an economic point of view, what makes sense, and can you do it without tax abatements or help from policymakers?
Yeah, that was going to be my next question is we know that there are obviously tax credits involved in terms of doing work on historic buildings, but if you've got something perhaps from the mid 60s and you can't access any kind of taxable benefit there in terms of adapting, that's not really going to push the needle. So are you seeing much movement in terms of policy at the state level to encourage that kind of adaptation and put in some more benefits for folks in terms of tax policy?
Yeah, you know what? There's talking about a lot of stuff, and the session is in swing now. So let's see what these folks actually implement. But as they say, talk is cheap. We need to see something tangible happen to help this. I know in New York, and it's probably like this in a lot of places, we desperately need the housing. We have too much office space, and there's a real opportunity to do something great, provided that common sense can get in the mix and feasibility comes into play. Our policymakers often are not really in tune with what reality is. With regard to our 421A tax abatement, for instance, which really catalyzes rental construction, you look at the issue and a lot of the elected officials say, well, we don't really need that. All we're doing is lining the pockets of the developers and they're going to build anyway. And then you look, and I'm coming out with my land index data within the next few weeks. And as an example, when you had the tax abatement in place, in 1 year, we had 1.5 million feet of rental apartments built in Manhattan. And 2 years later, without it, we had 38,000 feet. So tell me, how can a rational person say, okay, you have the abatement, you have 1.5 million feet built, and without the abatement, you have 38,000 feet built? So you're telling me you still believe developers are going to build anyway? Well, you have to be a total knucklehead to think that. So hoping to sit with politicians, go through these numbers, and with numbers, and math doesn't lie, with numbers try to explain that, you need these incentives to make things happen. And I think politicians have to get on board with that. And very, very important. Policy is very important with how the markets function.
Thanks, Bob. Common sense is in much needed, and so Godspeed on that.
Thank you.
All right, up next we have Kevin, and then we have Hardesh, and then again, don't forget we have a hard stop at 12:55.
Hardesh, you're on mute.
I think Kevin is before me. Kevin, you asking a question?
Yeah, Kevin, are you
Oh,
able
Kevin,
to
sorry.
connect? Actually, I don't even see him anymore.
Well, thank you, Bob. It's a pleasure meeting you virtually. So I'm a residential investor. I'm Canadian. So as you know, Canadian is not a good environment for the investor. So I moved to US, especially in New York. So before COVID, I took some recon in the Lexington and Manhattan area, which is 1,200 square feet. And then during COVID, bought an LIC. There's some condos was developing around 900 square feet kind of things, which is going well. I mean, I'm having good tenant and working fine. I'm looking for the future perspective. What do you think in New York market, especially residential? Is a good investment for long term, or we have to look outside New York, or maybe New Jersey or Florida? I don't know. That's what looking your opinion. Anything helpful?
Yeah, well, I think the appealing thing about New York is I do believe that, and notwithstanding the political headwinds that I discussed, I do believe that the political winds will change in the future. And I think to be able to buy buildings at the very low price per square foot that you're able to buy them at today, I think long term that is a sound investment. Forget about buying below replacement cost. A lot of these buildings are selling for less than the land value. So you're getting the land at a discount and the building's free. So I think inherently that's a good investment. I'd love to talk to you about some of the opportunities we have. If you email me at bob.knakal@jll.com, I'm happy to offer you those opportunities and see what's what. But I think that because of the very, very low value that properties are trading for today, I think there is an opportunity there, particularly if you're looking at things from the long term.
Sounds good. Definitely, Bob. I will send you email. Get in touch with you. I'm looking at it.
Perfect.
Thanks.
Thanks, Hardesh. Nice
Same
chatting with
here.
you.
Okie dokie, Kevin, you're up.
Hey, good afternoon. Sorry about that. I had some connection issues. Nice to meet you, Bob. My name's Kevin Galliano. I'm from New York, Hudson Valley, exit 17 off the thruway.
Nice to meet you, Kevin.
You too. So I'm in my late 30s. I'm a lawyer. I do a little bit of real estate investing myself, single family stuff for now. And I was curious from your perspective, looking back, what are some of the important things that you would suggest to do in your 30s to set yourself up for later on in life, if you could share any advice?
Yeah, I mean, I think whether you're in your 20s or 30s or 40s or 50s, I think to create value in yourself, regardless of what industry you're in, I assume most folks on the call are in the real estate industry or tangentially related to real estate. You create value in yourself by being an expert. I think that is a way to ensure that things are going to be good for you for the future. I would also say, and this is going to sound really weird coming from a guy who doesn't buy real estate, but I would understand taxes and depreciation and how the only thing that really matters is what you're left with after taxes. How much you make and everything else doesn't really matter. It's how much are you left with. And the folks who I've seen do extraordinarily well are people who understand how to essentially pay as little tax as possible. So I think that's really important. And I went all in on trying to create a company that would be valuable. And if I sold it, I'd pay capital gains taxes, not ordinary income. And that worked out. But I think the path of understanding real estate investment, the power of depreciation, how to focus on after tax proceeds is a huge thing for folks. And particularly if you're young, think about how much money you can make, save, grow by focusing on taxes. I think everyone should be a tax expert and learn as much as you can about taxes.
Excellent. Thanks, Bob. Nice to meet you.
You got it, Kevin. You too. Mo, I
Hey.
think we have time for one more.
Perfect. Yep. We have, let me get him up as a speaker. Sorry. I was trying to multitask.
Yeah, and also, folks, send your questions in, and I'm happy to get to them at some point today. And we'll be happy to answer them. And also put in a plug for the Bob Knakal 2024 baseball card, which is just out, the new version. So if any of you would like a baseball card, just shoot me a DM or an email. Email's preferable. bob.knakal@jll.com. Happy to send you a new edition baseball card, hot off the presses.
Awesome. All right. We have Nick Adler up next.
Hey, good morning, Bob. This is Nick in Hawaii. I'm a commercial broker out here. I actually just got your baseball card in the mail, so thanks for that.
Oh, you got it, Nick. Aloha.
Aloha. My question is just around scaling your business. I'm sure you're reading the 10X is easier than 2X, or maybe you've completed it already, but just shaking up your business to scale. I was curious, just your insights and your approach to client acquisition, high value deal negotiations, and just tactics like to shaking up your operations and who you're hiring to be on your team to push you forward.
Yeah, look, I could talk for 2 hours just on that topic, Nick. So let me just give you some of the highlights. First of all, 10X greater than 2X, easier than 2X, great book. Also read Who Not How, because Who Not How by Ben Hardy and Dan Sullivan also will tell you once you've figured out, I mean, the main thesis of 10X is that 20% of the stuff you do every day is what makes you most of your money. Take a look at that, figure out what the 20% is, and the other 80% either get somebody else to do it for you or don't do it at all. Who Not How will help you understand what to do with that part of the 80% you want to keep doing, but somebody else should do for you. But I think when it comes to scaling, is really figure out what it is that you are best at. Hopefully you have a team. I think everybody has to have a team of people. Nobody can do this business on their own. You have a team of people, rely on those folks and have them do things that are important, but try to do yourself the things that are most important. For me, there's three things. It's prospecting, number one, pitching business, number two, negotiating deals, number three. Those are three of about 50 things that you have to do as a broker, and you got to have other people do those other 47 things for you for the most part. So I think it's figuring out systems, bringing people on board to help you. I think that AI is changing the world. If you have an opportunity, talk to Rod Santomassimo at the Massimo Group. Full disclosure, Rod's my coach. He's one of my best friends. And AI is changing the world. You can do a lot of stuff that you don't have to go out and hire people for hundreds of thousands of dollars to make this happen. You can use AI to get a tremendous amount of stuff done. I think I will tell you, I've said this a number of times. In 1984, I sat at my desk. I had no computer, no fax machine, no cell phone. Today, 40 years later, the world is so different, but the extent to which the world is going to change over the next 5 years is going to be much greater than what we've seen over the last 40 because of AI. So understand AI, use AI, call Rod. Rod, I'd say, is the leading authority on AI in real estate in the United States. Call him, it'll change your world. And get a team together, use AI, have other people help you figure out what you need to be spending time on, and grow, have the team with you. You can't do everything. You have to delegate. And I think it's awesome you're reading 10X. Read Who Not How. I think that will change your life as much as 10X will.
Mahalo, Bob.
Mahalo.
All right, we are coming up on your hard stop, BK. So if anybody needs to get in touch with BK, you can email him at bob.knakal@jll.com. That's bob.knakal, that's KNAKAL @jll.com. And also send us some DMs of what you think the next topic should be. Bob and I have been talking about doing this maybe once a month. We'll see what happens with his schedule because he's super busy. But we would appreciate you guys giving your input.
Yeah, Mo, thanks again. As always, couldn't do it without you, my friend. You're the best. And everybody have a wonderful, productive day and work on your business a little bit today. It's a Sunday. Watch some football, have some fun, spend some time with your family, but do a little work on your business and it'll make the week a lot more productive. Take good care, everybody. Go get them. Talk to you soon.